Welcome. I am David T. Phillips, CEO of Estate Planning Specialist, and your host each Wednesday for the podcast Estate Planning Made Easy, which teaches you how weekly to keep your wealth in the family. Well, we've had a couple of, I think, pretty good episodes so far with Estate Planning Made Easy. And today I want to talk to you about gifting. Properly gifting. Perhaps one of my most favorite Disney movies is Toy Story. And you think about Toy Story where Andy, when he would go to sleep or when he'd leave the house, the toys would actually come alive. They had personality. Well, the other day, I was going over to my son's house, Todd, the president of our company, father of 6 girls. And I just happened to get there at the time that they were purging the toy room. Now, purging anything is tough, especially if you really like something or you have liked it. And most of the gifts that we had given our kids and that the other grandparents and family members had given the kids, they really liked for a time, for a period. It's kind of like in Toy Story how Andy eventually puts all of the toys away, and it's pretty traumatic for him and especially for the toys. But I get there to the house, and there they are, and they're deciding which ones to keep and which ones not to send off to Goodwill, and they're putting them in bins. And I thought about how fleeting those gifts were, and wouldn't it be cool if I could give something to them that would really be of value? And when I look at estates, when we're planning estates, I see this go on time and time again, where people are not actually understanding the power of gifting, and especially leverage gifting, on how leverage gifting can make a huge dynamic difference in the entire family for generations, not just first generation, but multiple generations to come. And so I want to spend some time today talking about gifting. The other day I had a client come into the office, and it seemed to me after we were talking that his estate was right around, oh good heavens, it was almost $9 million. And he had some money in an IRA, and they're approaching 70. They were going to, RMDs were going to kick in pretty soon. And I thought about this, and I said, this guy is really set. And you know what his number one concern was? It was that he was going to run out of money. That if he gifted too much to his kids and to his grandkids, that he wouldn't have anything for himself. And, first question I asked was, well, what are your annual living expenses? I mean, you're obviously getting Social Security now. So what are your total annual living expenses? And they were really only $200. They lived rather modestly on $200,000 a year. Now, they didn't fly a lot of first class, but they were very frugal with their money. But with just simple estate planning and financial planning on the front end, there is no way they should ever run out of money, even if they live 20, 30, or even 40 years into their hundreds. Proper estate planning and financial planning go together. And we designed a plan for them. That was the whole idea. They called and said, what can we do? We want to take advantage of the gifting laws, and we want to also take advantage of, we want to make sure we don't run out of money. And so with proper planning, just a little bit of tweak here and there, we made it so that they will never run out of money, and they can fly first class for the rest of their life. So that's proper planning. And we also set it up so that they could start doing leverage gifting. So most of you probably know, if you've done any research at all on this, that gifting is a use it or lose it proposition each year. We have an allowance that is given to us. Currently, the allowance is $18,000. I can give $18,000 to Todd, gift tax free, no taxes, no strings. It's out of my estate. I'm irrevocably giving it to him, but there's not going to be any taxes to him. There's not going to be any taxes to me in the future. My wife Jane can do the same thing. So together we can give 18 each, or $36,000 per couple. Now, if we have 4 kids, for example, I could give $72,000 and Jane could give $72,000. So that'd be $144,000 out of our estate and never to be taxed again. Never, no estate tax, future estate tax, no inheritance tax, no gifting tax, period. Just gone out of the estate. And you could actually argue that you could do the same to anybody. You could give to the bum on the street and give him $18,000 to get it out of your estate. Well, the idea of gifting is really a good idea, and it's an idea that we should use. But gifting today and letting them have the money today is not necessarily something that you have to do. You can actually do what's called leverage gifting. In fact, we have a little term for it. It's called the gift tax leverage strategy. And in essence, what we're doing here is we're taking that annual gift, and rather than just give it to them as a gift that'll eventually make it to Goodwill, they're going to be good stewards of, you're going to be good stewards of your money, and they're going to be good stewards of the money, and that money is going to grow exponentially. So let me give you an example on how this would work. Let's say we have Bob and Sue, and Bob and Sue have just one child in this example, and they both use their $18,000 exclusion, so $36,000. Rather than give it to their son Ron to spend right now, they're going to defer the gift by securing a joint and survivor life insurance policy. See where I'm going with this? So this life insurance policy, because it's a joint and survivor plan and they're 65, will grow to $3 million. $36,000 deposited each year into a gift tax leverage strategy will produce, for a 65-year-old couple, will produce $3 million tax-free. Now, in your show notes, I'm going to have a table that will show you what your deposit would be to create $1 million of tax-free joint and survivor life insurance for ages 60, 65, 70, and 75. So you can kind of see how that leverage will actually works for all ages. But obviously, the younger you are, the more leverage you're going to create with the gift tax leverage strategy. But in our example of Bob and Sue, they were both 65. And the simple gift that they have, the allowance that they have, $18,000 a year, 36 between the two of them, would create $3 million tax-free to their son. Now, let's say their son has 5 kids. Well, what does that do? What is $3 million that they get when the surviving spouse passes away, their surviving parent passes away? What does that $3 million do, not only for them, but for their kids? It can change lives. And if you set it up correctly, it will be income tax and estate tax free. So give our office a call at 888-892-1102. 888-892-1102. Give our office a call. Ask for me personally, and my staff will set up a time when we can talk together about how the gift tax leverage strategy can work for you. And I also recommend that you get my book, my recently edited and updated 4th edition of the 10 most common estate planning mistakes and how to avoid them. Because in there I have a table that will explain to you how this works. I will also, in show notes, I'm going to show a table very similar to this table here, showing you again what that gift tax leverage strategy would look like if you wanted to create $1 million and you were 60, 65, 70, or 75. And then I also want to remind you that each month, myself, Todd, Rick Durfee, and Melody Gatz produce a newsletter called Generational Wealth Strategies. And I've talked about this gift tax leverage strategy before, but in the newsletter, we We first started the newsletter in June of 2023. We're almost to a full year now. In fact, I will be writing my May issue next week. So that'll be our 11th edition of the newsletter. So when you subscribe to Generational Wealth Strategies, and you can do that going to the website generationalwealthnewsletter.com, subscribe to the newsletter, you will get all the back issues. And there's been a lot of topics that I've kind of covered here in the podcast, but a lot more in detail. And then you'll also have Todd's input. Every month he covers the annuity of the month and in a safe money corner. And then you'll have Rick talk about, in his column, the sustainable legal solutions. And Melanie will talk about charities and how to implement charitable giving into your estate plan. So order the newsletter through generationalwealthnewsletter.com. Go to the website, epmez.com, or shop.epmez.com, and check out the different reports and books that we have there so that you can get further education. We're going to next week on Wednesday, because every Wednesday is when we broadcast this. I'm going to be talking to you about probably one of the most serious mistakes of all. And it's a mistake of not properly planning for the exorbitant cost of a long-term medical event or a long-term care event in your life. Now, we've all lived through it. Parent, grandparent, friend has gone through this. We've seen how it changes a family's dynamics. And it will, especially if we're not prepared. But we can be prepared. We can actually be prepared for this. And so I'm going to be not only explaining to you, our listeners, the problem, but I'm going to give you a solution on how to take care, how to get this mistake out of your life forever and get this long-term care crisis behind you. I've seen long-term care events destroy not only the wealth of the individual, it's reduced their income significantly, but it wipes out the estate and there's nothing left for the family. So we need to prepare for this one. Given the fact that 72% of all Americans will have a long-term care event if they're over 65, given the fact that if we're married and we're 65, one of us is going to live into their 90s, given the fact that 80% of all women will have a long-term care event in their life, we need to be prepared for this one because this one is inevitable for most of us. Anyway, until next week, this is David Phillips signing off. Have a great day.